welcome to the September investment meeting. I will now turn it over to the trustees for introduction.
Good morning, everyone. Rosemary Tabellas, representing Commissioner Kelly.
Doug Maynard, representing Commissioner Kelly.
Barry Dennis. Joe Alejandro, PBA.
Vincent Valley, SBA.
Lou Turco, LBA.
Chris Monahan, CEA.
Michael Paladino, DEA.
Karen Paxtis, DEA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Martin Gans, Controller's Office.
Stephen Verani, Controller's Office.
Thad McTee, Controller's Office.
Larry Schloss, Controller's Office.
Justin Holt, Department of Finance.
Janice Emery for the mayor.
Bob Sansky, State Pension Fund.
Nicole Jambrisi, Pension Fund.
Alex Bernier, Controller's Office.
Liz Caldas, Controller's Office.
Dan Haas, Controller's Office.
Captain, Controller's Office.
Alrighty, I'll turn it over to Larry.
Thank you. So we have the performance reviews for the year. We'll hand over to Martin, and then we'll go by asset class, get to July, and we'll do a little IPS update.
What's your extra? One extra. There you go, Mark. One extra.
So we're going to start with the pension fund, and this shows the quarter as well as the fiscal year numbers, and later on we'll go through the VSF. But before we start on page 8 with the number, I just want to remind you that while we'll go through June here, Larry, in a very short while we'll go through July with a hint of August. But the June quarter was really a time in the market where there was a shift in sentiment. Until pretty much the end of May, it was risky assets doing very, very well, high yield U.S. equities, and all other risky assets. And then Ben Bernanke started talking about his famous tapering, meaning the slowdown in the bond buying program, and then interest rates started going back up, and they started going back up significantly towards the end of June, just happened to be at the end of our fiscal year. And that started affecting equities as well, and all risky assets, but specifically, as you'll see in a moment, interest rate sensitive products like emerging market equities, TIPS, treasuries, REITs. But for the fiscal year 2013, the results weren't quite good on an absolute basis. So if you turn to page 8, for the quarter on the left, you can't even see the bar because of the scale. The return was roughly flat, -9 basis points behind the benchmark of 59 basis points. We'll go through the details of that in a moment. But for the fiscal year, it was a very strong 12.28. That was behind the policy benchmark of 12.99, but a very strong absolute return. And we'll go through the attribution in a moment. And for the 3 years, it was 11. You're now at 11 3/4, also behind the policy benchmark. The 10-year number is over 7.5%. The next few pages show the asset allocation. We have two. One is the asset allocation as adopted, and on page 10 shows the asset allocation with the so-called parking places. And this is what we managed to, as the board adopted. So a couple of things jump off the page. Obviously on the top is the pie chart in green. The largest allocation from about 1 o'clock to 4 o'clock you see is U.S. equity. But on the bottom we show the overweights and underweights. And on the left you see in green an overweight to U.S. equity, which has been fairly persistent throughout the year. And in the middle you see in blue and what I would call light purple? Lavender. You have underweights to core fixed income, core plus 5, as well as TIPS. And this shows up in the allocation effect in the performance over the next few pages. So the next few pages shows performance attribution. So while the fund underperformed on page 11, you see the -9 basis points for the total fund versus the policy benchmark of plus 59. The allocation effect was nicely positive at 32 basis points, and that's attributed to the overweight in U.S. equity, which did well versus the overall fund, and the underweight to the core plus 5 and TIPS. The negative management effect, which is a full percent, is primarily due to private equity. In this case, mostly due to the lagging effect, but in a moment, it's more than that, as you'll see. On page 12, similar numbers. This is for the 1 year, full fiscal year number, the 12.28. Again, the U.S. equity overweight helped. The underweight to core plus 5 and tips both helped because, as you'll see a little bit later, those returns were much lower and in fact were negative. Any cash that we had hurt, but it ended up at a net positive 44 basis points. The negative management effect is almost entirely due to private equity. U.S. equity managers, as Seema will talk about in a moment, actually did very well, and that helped. On page 13, you see longer-term numbers, 3-year numbers, and you see negative effects here. The allocation effect, that's mostly cash, and the management effect is private equity. In this case, this is no longer timing in private equity. This is now bad performance, not bad performance, underperformance or bad performance in private equity itself, in the program itself. So in the short run, it's timing. In the long run, it's underperformance for private equity. And that jumps off the page if you take a look at page 15, where we have the management effects. If you look at the 3-year number, it just jumps off the page, as well as the 1 year. The 1 quarter, there's a typo with private equity. It's not 0.3, it's actually minus 1.03. So it does jump off the page. Private equity, short-term timing, long-term underperformance. So how did police do versus other large public funds? If you turn to page 17, on the left you see the 1 quarter, so the minus 9 basis points put you just outside the median. You were in the 58th percentile. The 1 year number, and if you look at the middle of the page, you'll see the bars, very wide dispersion for public funds from top to bottom. Police was in the 52nd percentile, just a couple of basis points off the median. It says 1225, but the number was 1228. And the 3, 4, 5, 7-year numbers are all in the second quartile. Unless you have questions, I'm going to turn it over to Sue.
Okay, thanks, Mark. If you turn to page 20, this is a snapshot of the domestic equity returns versus the benchmark, the Russell 3000. About $11.5 billion and 40% of the total funds is invested here. For the quarter, you can see roughly in line with the benchmark, but importantly, if you look for the fiscal year-to-date numbers, and on an absolute basis, very strong equity markets for the fiscal year, up 21%. But as you can see, the blue bar being the police portfolio, outperforming nicely relative to that benchmark. And I just want to point out, along the lines of what Martin said earlier, so a number of things helped in U.S. equities for the police portfolio this past year. Our asset allocation, the way we actually overweighted small cap and overweighted mid cap and underweighted large cap. You might remember we've done that now for a few years. That helped a lot for the fiscal year, and the actual switching of emerging managers, that program to all small cap mandate, actually helped as well, because then they, on top of that, strong performance in small cap, they outperformed. So we actually saw good active management adding value, and we saw a good result out of allocating the assets the way we did in U.S. equities. So to give you a quick snapshot, so the small cap index for that fiscal year period was up 24%. The mid cap index was up 25%, and the large cap index was up 21%. So that's the differential, 300 to 400 basis points. And then when you look within small cap, police outperformed by 300 basis points in small cap. A slight outperformance in mid cap relative to the index, and very nice outperformance in large cap on the active side versus the index by about 400 basis points. So all in a good fiscal year for U.S. equities. If you turn to the next page, this goes through just some more detail along the lines of how the quarter went. As you can see in the pie chart here, about 80% of the money is run passively. And I'll point you to a couple of columns, the index return, the actual return, and the difference column. Again, this is just for the quarter. But as Martin mentioned earlier, you can see the U.S. markets, as measured by the Russell 3000 index, was positive, up about 2.7%. And that's very different from what happened internationally, and we'll go through that a little bit later. But most of your active managers in the quarter also did add value, so a decent quarter. If you then turn to page 28, we'll go to international. So that's about $4.6 billion, about 16% of the funds. And if you look at the pie chart to the left right there, you can see that most of the money is managed actively, which is the opposite roughly to how it is in the U.S. And again, if I just point you to a couple of these columns, index, return, actual return difference, you can see that the IFA passive down about 1% in the quarter, and EM had a really tough quarter, down 8%. And again, that's different from the U.S., which is actually up close to 3%. And again, if you look in the difference column, the active management for the quarter did add some value across most of the managers. The next page is IFA breakdown. So about $2.7 billion, 9% of the fund. So if you look again in the quarter, it's behind the benchmark. Some of the IFA managers just getting going here. So you might remember when we did the new IFA search, the managers just started hitting the performance in May. So going forward, we're expecting a lot of good things out of those managers. But if you look in the fiscal year to date, you can see that a bit behind the benchmark again. And overall absolute returns, so IFA's up about 18%. Again, that's relative to an up 22% in the U.S., but still really strong absolute numbers. And again, we're going to look for those IFA managers to start adding a lot of good value. If you turn to page 35, that's the emerging markets detail. So about 6% of the total funds. You can see in the quarter actually slight outperformance relative to the benchmark for our slate of managers. And if you look in the fiscal year to date, also some nice outperformance. And again, you might remember now we've had the new emerging market managers for the full time period. And so those managers are helping, which is a good thing. But if you can look at the absolute return numbers, you can see that, about 3% is a lot different than up 22 for the U.S. and up 17 for developed international. If you looked at to page 37, quick snapshot of the hedge fund program. Currently, right now, about 3% of funds, or as of June 30. You can see in the quarter, the portfolio didn't do as well as our benchmarks. June was really the tough month for the program. We were doing quite well going into June, and June just across the board, it was very tough. Down about 3% for that month, so that's what took us down for the quarter. But if you look at the fiscal year to date, numbers still very nicely outperforming both of our benchmarks. So up about 9% net, which is we think a very good number. You might remember the way we tried to target and set up the program, which was to try to hit a net 8 to 10% return with low volatility to the public equity markets, low beta to the equity markets, low correlation, and low volatility. And so we did that net 9% return with about a 0.14 beta, so less than a 0.2 beta, which is what we wanted to do, about a 0.4 correlation, which again is around where we wanted to do, and a 4.5% volatility, which again is about what we were hoping for the program. So far so good. We still have a ways to go to build it out, but it's headed in the right direction. If there aren't any other questions, I'll turn it back to Martin.
Okay, so please turn to page 39, where we have a pie chart of the fixed income allocation, and the largest allocation is shown in blue, and that's the core fixed income allocation. As of June 30th, over 30% of your assets, or nearly $9 billion, was in fixed income. The largest program is the Core Plus 5, and that's further broken down on page 40. That's 17% of the assets. And you'll see in the over-underweight column of the three sectors, and we've had this weight on for about a year, and this quarter it really did have an effect, as you'll see. The underweight to the government sector, Treasury agencies, and overweight credit to the spread sectors, I should say. And when you look at the actual returns, or even the index return column, the government sector was minus 4% and change. The mortgage sector was less than minus 2%, and the credit sector was minus 3%. So our over and underweights, the allocation effect, if you look at the contribution to performance, helped. So being in the right places helped, being underweight government and overweight spread sectors. So putting it all together on page 41, you'll see on the left a negative number, minus 284. That's not good to have a negative number, but that was 7 basis points ahead. The managers themselves were somewhere above the benchmark, somewhere below, mostly very close. And in fact, the programs themselves, the government program was right on top of the benchmark, and the mortgage and the mortgage and credit sector were 1 or 2 basis points off. Fiscal year to date is an interesting number, the 12-month. It's one measly basis point was the return for the entire year, but in that very low return environment, we still beat the benchmark by 96 basis points. So in an environment of low returns, beating a benchmark by 96 basis points, nearly 100 basis points, is very valuable and very helpful. 3 years is still positive, and the longer term numbers are still positive, obviously, between 5 and 6%, ahead of the benchmark as well. Over the 1 year period where we had flat returns, of the 14 managers, 11 beat the benchmark. Of the 3 that did not, 2 were government sector managers, State Street and Fisher Francis, and primarily that's only a few basis points, and primarily due to the May and June time period where interest rates changed quite a bit, and managers were trying to figure out, are rates going up a lot, or should we stay the course? But the basis points were only a few. We had 1 mortgage manager underperforming Wellington, and again, that was only a few basis points. Tips are on page 42. And you'll see on the left the performance. I mentioned in my first comments that the worst returns were in the Treasury and interest rate sensitive products. Tips were your worst returns, returning minus 7% and change, just off the policy benchmark. And I just want to make it clear, you think of tips most likely and say inflation. So did inflation go down 7% in the quarter? And the answer is no, it didn't. So why do we have minus 7% returns? And the answer is there are 2 components of return. One is the inflation component, which is 2 or 3%. You'll see in the economic charts. But there's also duration. Real returns, real rate of interest rates, historically sort of follows the growth, real growth in the economy, which is about 2 or 3%. Because of the Fed's policy, it was near zero. Rates finally rose. When rates rise, prices go down. Real rates rose, 10-year duration, so we lost 7%. Fiscal year to date also lost 4.5%, but that was ahead of the benchmark, if that's a consolation. The good news is the longer-term numbers are positive for the program. High yield on the next page, on page 43. That's slightly negative numbers, minus 122. That was 30 basis points ahead. And very strong numbers for the fiscal year to date, over 9.5% and over 200 basis points ahead of the policy benchmark. And strong numbers, 10% out to even 5 years, and over 200%. 200 basis points ahead of the policy benchmark for the 5-year period. Convertible bonds on page 44, positive numbers, and that's because convertible bonds are more sensitive to equities than to fixed income, and equities did well or did less poorly. And so we have positive numbers of positive 139. That's behind the yellow bar, but ahead of the purple bar. The purple bar is the custom index, which is the weighted average of Advent and Victory, your 2 managers, which both beat the benchmark for most of the periods. So you see that the blue bar is ahead of the purple bar for most of the periods, but behind the yellow bar, which is the overall convertible bond benchmark. Opportunistic fixed income was the star in fixed income for the year. We'll talk about that a little later in the executive session. Page 45, you see strong returns over 5.5% for the quarter and nearly 19% for the year, and double-digit returns out since the numbers that we show you, 5 years. A very interesting number is below, which is the volatility. We picked the J.P. Morgan High Yield Benchmark plus 3% to give you some element of comparison and volatility. And the returns, the volatility of the fund plan versus the index are almost right on top of each other. That is probably somewhat of a coincidence, but it is good to know that it is a reasonable proxy for volatility, at least in this time period. Kathy's not here for ETIs, so I'll go through this with you. On the left side, you see that the number is slightly negative, but it was 172 basis points ahead of the policy benchmark. And for the year, the return was 304 versus negative returns, so 400 basis points ahead of the index. Your PPAR and CPC programs did well, Access Capital did okay, and the AFL-CIO was slightly below the benchmark. If you turn to the big book, if you don't have the big book, we have extra copies here. For the ETI program for your collateral benefits, I want to turn to page 7 of the big book. Page 7. And you'll see in the top set of columns, the last column on the right, there were $25 million in new commitments for your PPAR program in the quarter. And one other important thing that I want to bring up to you for ETIs is on page 13. The first investment in the MS fund was made right before the end of the quarter. It's an investment in Brooklyn. If you know Brooklyn, this is Flatbush Avenue. It's the sort of just below the southeast corner of the park on Flatbush Avenue. It's a retail environment. It's a dense neighborhood. MS bought the property. They're going to be making repairs, preserving jobs, adding construction jobs, and filling vacancies, and this will be helping the community and jobs as well. Are there any questions?
Yes, Martin, I have a quick question. Who's going to be heading up the ETI program going forward? In the comptroller's office?
Larry, you want to take that?
Sure. The ETI program is a separate division of the Comptroller's Office. It's headed by David Morris. Kathy worked for him.
And does he have an investment background?
I don't think so. The investments run through our office. The collateral benefits, if you will, run through his office. So we have a team that's run by Martin who looks over every ETI investment that we make. I said we have a team headed by Martin that runs through every fixed income ETI that we look at, or if it's real estate, the real estate team does.
Okay. So since Kathy retired at the end of August, Martin's team is assuming responsibility?
No, Martin's team had the investment side of it throughout. Again, when it got separated, it became ancillary benefit team, if you will, or a source of deal flow for us, but all the analysis was always done by BAM. It was never delegated to somebody else.
Right. Well, I know Kathy.
Sorry, I said the investment analysis has always been done by BAM in the investment office, and continues to be.
Okay. And so there's nobody from Kathy's old team who will be continuing to do any investment analysis, that's all coming from BAM today?
Yes.
Thank you.
Welcome.
Ready?
Please.
Okay.
Thank you,
So,
Mark.
You're welcome.
I'm starting from page 19 in your booklet. And this is the, yes, in the big book. So this is the quarterly report for private equity ending the first quarter of 2013. Just wait till you all get your books. And again, it's 19, page 19. Okay. So, so I'll just start with the table that's right there in the center of your page. Again, with your private equity portfolio, you have $3.9 billion committed across 158 funds, and that represents 106 actual relationships. For the quarter, you've up to the quarter, the first quarter of 2013, you committed $3.8 billion, contributed $2.5 billion. You got back $1.5 billion. A market value of $1.9 billion, which gives you a total value of $3.4 billion. Your total value multiple for the quarter ending was 1.34 times, and your IRR since inception is 9.7%. So close to a double digit. So very excited there. If you turn to the next page, you'll see how you performed against the benchmarks. You underperformed against the Russell 3000 plus 300 basis points. But if you look at the Thompson 1 median IRR, you actually overperformed, which came in at 4.2%. And if you turn to page 30, you'll see the new commitments that we made during that quarter. So during that quarter, we committed $152 million across 3 funds. The Landmark Equity Partners 15, and then the Landmark Sidecar Fund, the co-investment fund as well. I'm sorry, 3 funds. And then you've got Neuberger, the strategic co-investment investment, and then Acon Equity Partners 3, which was an emerging manager private equity fund. Then you look at the table below, it's all the commitments that were made subsequent to that, which totaled $244.9 million. And then 3 of them were in core relationships, and 4 of them were in emerging manager relationships. So we continue moving along and in progress with new commitments. If you turn to page 33, you'll see how the strategies are working for you. And you'll see that growth equity here is actually leading in terms of your performance for the quarter, coming in at 17.6 IRR, led by some great names like Vista, and then Warburg Pincus, which was a new relationship for you all. Second came in at secondaries, which gave you an IRR of 17.1%, and that's really led by great performers such as Landmark, Lexington, and a new relationship, AXA. And then followed by special situations that came in at 12.8%. And those are, again, existing great relationships as Ares, and another one such as Platinum, which was a great new relationship for you all. And then followed by Buyout, which came in at 11.3% IRR. And the biggest group there was the large Buyout, which delivered a 25% IRR to you. And a lot of that came from CVC, Apollo, and Carlyle. So great performing funds doing well for you. Turn to page 37, which will be my last point that I'll leave you with. It's the cash flow. It's the activity of the capital coming in and the capital going out. So if you look at the bars below, that's the contributions that you did, and this shows you a nice visual quarter per quarter. So you'll see for the first quarter 2013, you contributed $64.9 million, and you got back in distributions $72.1 million. Which is nice when you look at it against the other first quarters in 2011 and 2012. You came in much higher in this quarter, so certainly showing signs of progress and improvement. So that pretty much wraps up the private equity quarterly. Don't know if anyone has any questions. Thanks.
Thanks, Molly. You want to do real estate?
Yeah, so immediately following the private equity presentation, the board book on page 47. Actually, I passed out some color copies because we do have some graphs that have some yellow bars in it, which don't necessarily show up. So this is a redesigned quarterly report, and it has a fresh look. Read it through when you have a chance. We're really, really looking forward to your feedback. Our objective here was to make it a little bit more user-friendly, especially on the first page, so that you can get as much information as possible about your portfolio right here on the first page. I'm not going to go through the whole thing. We're going to spend more time on it next time we see each other. But the following pages are in-depth commentary on the portfolio construction, your core and non-core, your performance, which parts of your portfolio, core and non-core, are performing for you, details on attributions, which managers are really driving your returns and which ones are not. But just let me give you a couple of highlights of how the first quarter of 2013 performed for your real estate portfolio. So the real asset allocation is 6%, and that equates to about $1.7 billion at that time. For real estate, your market value of your portfolio was slightly north of $900 million at $919 million. We had about $342 million of commitments that we haven't funded yet. So overall, your exposure to the real estate asset class is about $1.3 billion, and we have about 44 investments globally and 31 managers hard at work. In terms of your quarterly performance, the quarterly performance for the police portfolio was 2.8% net, right on top of the benchmark. The benchmark for the real estate program is Odyssey net, plus a premium of 100 basis points. That's in recognition of the fact that we have a portfolio that has both core strategies, which is directly linked to the Odyssey. We also have non-core strategies where you would expect some higher returns there. And as it relates to the portfolio and how it's constructed right now, we're about 33% core plus strategies and 67% non-core. Policy says that over the long term, we're kind of striving to keep that band of within 40 to 60%. However, over the last 2 years, as you know, in our annual plans, in order to take advantage of the distress that's in the economy today, we did recommend, and everyone had supported, an overweight to non-core strategies. Going forward, and we'll talk a little bit about that in executive session, we'll be talking about how we're going to return to a more neutral stance. So your portfolio over the near and long term is in a over here in the lower right-hand corner of the first page. And we've had some mixed performance for the long term. However, for the quarter, the 1 year and the 3 year, our post-recovery returns are quite strong. And that would include, if you all have any other questions, we could talk some more later on in the agenda on real estate. Thank you.
Barry, you had a performance review for us?
Yes, every once in a while, we take a look at the big picture over the longer term, and we do some additional metrics on the portfolio performance, so that's what this is. Overall, it's a very good report card, make no question about that. On your page 60, just some definitions. In this report, we compare you to public funds with more than 10 billion. Other places, when we do your performance, we use a universe that goes down to 1 billion. The $10 billion group is a tougher group to perform against. And if we go back to the 1 billion cutoff, your ranks improve by 10 to 20 percentiles, just FYI. And this greater than 10 billion is a pretty skinny universe, so you can have some wild swings with some small performance differentials. When we look at the asset classes, we compare you with other funds' asset class performance. So those are good comparisons. When I refer to the policy index, that's the adjusted index that Martin refers to. And when I refer to the allocation index, that's a calculation that takes your actual weights, not your policy weights, and index performance at those actual weights. So the difference between the allocation index and the policy index will tell you how your deviation from your policy targets has performed. It'll evaluate your timing. And I'm only doing this on the public asset classes. If we go to page 61, again, big picture. The policy index, that's the adjusted policy index, when we look at its ranks across time, they're excellent. For 3 years, it's in the top percentile. And for other cumulative periods, it's top quartile. That's on page 63, if you're looking ahead. And I say the board controls the policy, so congratulations to the board. The second takeaway is that over the vast majority of periods, the allocation index outperforms the policy index. So these timing decisions that Martin referred to, where you're underweight TIPS and you're underweight public fixed income, that's been a home run. And to that I say congratulations to the Bureau of Asset Management. And when we look at how the actual results fared against the policy, there is some trailing, very narrow over the long term, but quite substantial over 3 years, 130 basis points. I'll get into why I think that's occurring a little bit later. Now, because of the skinniness of the universe, you get some screwy numbers. And so if we look at the cumulative ranks, they cluster around the median. But if we look at the rolling 3-year ranks, they're all above median, with the exception of the global financial crisis. So I would say when we try to correct for that small universe, I can say that your returns on a rolling 3-year basis have been consistently good. And consistency is a good attribute to have. Now on page 62, we'll learn that the big asset classes, and your two biggest asset classes are U.S. equity and U.S. fixed income. Those have actually beaten the benchmarks. Then we have smaller allocations, 10 and 6%, to international developed equities and international emerging equities. And those have sort of come and gone. The 10% allocation has actually done a little bit better, and the emerging, like I said, comes and goes. By inference, you can deduce that your shortfall to the policy is occurring in the illiquid asset classes. I think Martin addressed the private equity. It's very hard because of the lag in valuation to keep up with a rising public index. And previously we had a 500 basis point premium. Now it's down to 300, but it's a really hard hurdle to keep up with. And then in real estate, As Yvonne showed, the 3-year number is actually running ahead of benchmark, but when we go beyond that, we're getting a drag. And I can attribute that to some very large allocations that were made previous to the financial crisis, 2006, 2007. If you look at the pacing, that will bear that out. And then we're going to look at some risk-adjusted returns, and the Sharpe ratio is what we use at the total fund. Take a look at that formula. So a Sharpe ratio is you take the fund return, you subtract a cash return, and then you divide that difference by the standard deviation. Okay? So if you've had cash in your portfolio, that numerator becomes cash minus cash, or 0. So cash does not produce a positive information ratio. And if you have a negative returning asset classes, that contributes a negative component to the overall Sharpe ratio. If we look at the 5-year result for emerging markets, where we have a 6% allocation, small in relation to the other allocations, but big in relation to what other funds are doing in emerging markets, that hurt on the 5-year basis. So that's going to explain some of the lower Sharpe ratios we see. So if I go to page 63, you can see your ranks cluster around the median, although the 10-year percentile is in the top third. Again, if we reduce the universe size to $1 billion cutoff, those ranks go to 45, 40, 38, and 24 for the 10-year. So about 10 percentile points higher. And then on page 64, you can see the rolling 3-year ranks all fall at median or better. So you've been very consistent. Let's jump ahead to page 67 and talk about the U.S. equity. You had a great year in 2013, as Seema pointed out. And you are now above benchmark for 10 years because of that good year, and actually above peers over 5 years. The payoff came in small cap, the overweight to small and mid. That hurt the last fiscal year. It rebounded very strongly. I think when we look inside, we find that for that year, we had very strong outperformance from Zevenbergen, who had just a dismal prior year. And the fundamental indexers, VTL and RAFI, have been consistently quite good. Now, my message here is when you're investing in large cap, it's very hard to beat the index. That's been proven time and time and time again. You had a real good year in large cap. Most of your alpha came from large cap. Rather than become overconfident or complacent, this might be a time to look at doing more indexing in that area where you're currently 70% index and lock in some of those gains. You are very risk controlled in the U.S. equity. Extremely low tracking errors, and your beta just hugs that 1.0 like the markets, like a tight glove. Let's jump ahead to fixed income, which starts on page, 74. Make no mistake about this. This is the star of the show. Very strong returns. And if you go back to sort of the inception of the opportunistic fixed income, it's in the 17th percentile. Now, you might think you're taking a lot of risk because of the OFI and the convertibles and the high yield and the bank loans. Actually, your risk is average. Your tracking error is average to the sample, which makes your information ratios top decile, top quartile. This has been an extremely good performing portion of the portfolio. And congratulations to Martin and Adi and team. Next, let's look at the international portfolio on page 80. Now, just as a caveat, this analysis does not include generation and governance for owners, who have done very well. And if we include them, the numbers go up by 20 to 50 basis points depending on the length of the cumulative period. I'd also point out that we restructured this portfolio about 1.5 years ago, And actually, a couple of the new managers did not even have a full quarter at the time of this. So I wouldn't jump to any conclusions because that new structure is so brand new. Last year was a bad one for this portfolio. It trailed by 140 basis points, as Seema pointed out. And that, when I did this a year and a half ago, this was a very good performer, and that 1 year has soured the comparative results. If I look within the managers, the big shortfall came from Thornburg. You will recall that in the restructure, we cut Thornburg in half. There was a discussion about taking it all from them. Taking it halfway back was a good decision. Taking it all might have been a better decision with hindsight. But that situation should be revisited. Very low tracking error, despite the fact that it's only 21% passive. So there's probably a degree of over-diversification in that portfolio that we might want to see, or at least take a bit of time to see how the new managers take risks versus the benchmark. But again, too early to make a definite conclusion given that a lot of the money and a number of the managers are brand new. Let's jump ahead to the emerging markets, which is on page 86. Like the developed markets, this portfolio has been rejiggered, and the changes were probably even more substantial in this portfolio. 2013 was a good year, beat the benchmark by 50 basis points. However, only 2 of the managers beat the benchmark. The 2 managers that prior to last review had done great, Bailey Gifford and DFA, have both been struggling a bit. And on a cumulative basis, you look good over 1 and 10 years, not so good over 3 and 5 years. That sort of dovetails what the median manager does. So the median manager had a very tough time in the middle of that 10-year period because they went into the beginning of that period overweighting China, then underweighting China, and then began to overweight China just when China went into the tank. Now, China is making a comeback, so I expect to see the median manager do a little bit better versus the index. Again, too early to make conclusions. Tracking errors in this are low, but I would not advocate increasing the tracking error till we see some evidence that the median manager can beat this index consistently. So in summary, the results are good. The risk-adjusted results are fine. Need to be continued to monitor. The policy index is performing very well. Fixed income has been fabulous. And overall, the decisions made to vary from the policy, primarily being low on fixed income, have added a lot of value to the trust. Any questions?
Can you give us a sense of what our risk-adjusted return experience has been versus what our expectations were when we put this new policy in place?
So I guess I'd go back to, well, let's go to page 66. And you're talking about the total fund.
Right, total fund.
Okay. So when we did the study, asset allocation study, over the period of 2010 and 11, our expectation was 0.47. So basically exceeding it in the more recent periods and the long periods and falling short, particularly through the global financial crisis. But not too far off from the expectation.
Anything else? Thanks, Barry.
You're welcome.
Okay, so we had a very good last year, but last year's over. Now we start this year. So here we have the July monthly report. I go through pretty fast because it's a month. you need 12 of these little suckers to make a year. Let's start on page 34. Nice. So as Martin said, we had a great year going until Ben Bernanke decided to talk about tapering, and then the markets went a little crazy the second half of May and June, and people got calm in July because they sort of got the message out a little better. So July, there was a big recovery coming out of June. So if you look on page 34 at the top left-hand block of numbers, which represent the U.S. stock market, the U.S. stock market was up 5 to 6%. Excuse me, EFA was up 5%. Emerging markets were up 1%. Everybody was feeling pretty good. People were going on vacation. The Treasury market backed up a little bit, and the high-yield bonds did well. So again, we're going to have a good June because the U.S. market, of which we have the most exposure, is up 5 to 6%. If you go to page 30, you can see what that did to our asset allocation. Really, we didn't do anything to the asset allocation. But what happened, since U.S. equities were up 5%, we went out of the range on U.S. equities. You'll recall that we're set up, what I would tell you is perfectly correctly, for the last 12 months. We've been over-allocated to the max U.S. equities, which has gone up, and under-allocated to the max in U.S. governments and TIPS. So we're a little out of the ranges, but again, they came back in the range in August, which I'll tell you about in a little bit. It's 100% because U.S. stock market went up as much as it did. If you go to page 35, you can see that when the markets are up, we're making money. The far left, we made over 3% in the month of July, so that's a great way to start the year up. Virtually everything made money. PE and real estate are down a little bit, but again, everything was up and everything did well because, again, the U.S. stock market was up 5 to 6%. If you go back to page 27, you can see that at the end of July, we're up to $29.8 billion, which is the highest ever. We lost some money. We lost some of that in August, but again, September's doing great. So now I'm happy to report they were over $30 billion. Congratulations! Welcome to the Big 30. And if you go to the next page, page 28, you can see on a long-term basis we're now pushing 8% on our 10-year number. It's 7.88. That'll make Bob North very happy. So again, we're way recovered from the 08, 09. We've done very good work in the last several years getting there. Just to give you a little prep, August U.S. stock market was down about 3%, which helps us get back in the policy ranges. But at the same time, the stock market was down, as was the bond market, down about 1%. So my guess is by the time you see the August numbers, we'll be back in the ranges, just because the markets take care of themselves. So we probably lost a little bit of money in August. September's back up. So we're sort of up 3 coming in July, gave back a little bit in August, making some back again in September. So we're probably up 3-ish again, maybe a little more. So that's the month, a good first month. Stay tuned. That's July. Questions?
I have a question about a couple of charts in the July report.
Sure.
Page 23 of the book and 24 of the book seem to show PE ratios for equities, and specifically looks like there are some small cap indicators on here for the Russell 2000 index. And I'm thinking back to Seema's discussion earlier about our overweight to small cap in the domestic equity portfolio. And I wonder how these 2 pages inform that decision on an ongoing basis.
I'll defer that to Seema. welcome.
I mean, we do look at how expensive or how inexpensive small cap versus mid cap versus large cap looks on a forward basis and on a trailing basis, current basis. But, you know, we talk to our managers about that specifically. We don't just look at any one point in time, oh, you know, small cap looks expensive, let's just trade out of it. So we spent a lot of time talking to our managers about these kinds of things, and you know, we feel comfortable where we are. We're much more overweight if you look at our allocation to mid cap relative to the benchmark than we are in small cap. So again, we feel pretty comfortable where we are. You know, small cap has had a nice run, but that's this past fiscal year, or the previous fiscal year it didn't, you know, so I kind of feel like we're in a pretty decent shape. From what I can tell, earnings are coming in nicely for small cap companies. The U.S. market in general, I think you could say that for, so no alarm bells are going off right now, I can tell you that.
And what would cause you to change your opinion and to move back to a more neutral stance?
Well, the way we look at it is not just the PE itself, the multiple, but also how fast these companies are growing their earnings. So it's somewhat of a PE to growth rate multiple. And when that multiple tends to get way out of whack, meaning, you know, multiples over 2 and you go 3, 4, 5 times for your value versus growth, then you start to consider that. But right now, these earnings for small cap companies are still growing really well.
And are they actual earnings that you're looking at, or earnings expectations by analysts?
Forward earnings.
Forward-looking.
Yeah, I mean, a lot of these guys do it, IBIS and all these other.
And don't analysts
firms
tend to overstate earning expectations?
You know, I would have argued that, yes, that was true back in the 2000s, but they all learned a very hard lesson, particularly after Spitzer went after them. So I would say that Wall Street research analysts now probably underestimate because no one wants to get into trouble. And so they tend actually even to just put out what the company says that they're going to do, and they don't put any more into it than that. So that's why we have to talk to our managers because it's more important for us to know what their expectations are versus what Wall Street consensus is. So what I'm doing is we're always asking the manager, okay, where are your numbers based on, you know, your top 10 positions in our portfolio, and are they higher or lower or equal? Are we going to make any money on those top 10 positions, or are we going to lose money on those top 10 positions? So those are the kinds of conversations that we have. Does that help? Okay.
Okay. So with that, July's in the books. On to August. So last thing on our agenda is to talk about the IPS. Does everybody, you're going to hand stuff out? Okay, so I'll wait until you hand stuff out. Okay. So you're going to hand out a marked and a clean? Or just a marked and a clean?
Thank you. Justin, it's a blue line. It's blue for the police. It's a red line for the fire. Duly noted. Duly noted. You ready, Catherine?
I'm ready.
Okay. So So what we've done over the past 6 years or so is the board has approved a number of different things, like getting into infrastructure and changing from real estate to real assets, or changing the asset allocation a couple years ago. So what we had in our files was an old IPS dated December 17, 2007, and lots of pieces of paper. A lot of pieces of paper, which Catherine's going to walk you through. So we thought a better thing to do is to conform the old IPS and bring it up to date. In essence, take all the pieces of paper and put them back into one document and then redate your IPS and say, all right, it's all done. You've got one IPS and forget about all the loose pieces of paper that you have. So that's what this has done. There have been no policy changes other than the policy changes that have been approved. There's really nothing controversial in here. No liberties were taken with the IPS. It was really just conform what's already been done, put it in one document, and be able to have a clean document when you're done that is the IPS that has everything that was done in the last 7 years. So you want to give a quick walkthrough or preview as to what you did?
Sure. So as Larry said, this is just reflecting what's been approved. The list of those approved changes is on page 26 of the red-lined blue, it's actually blue-lined version. And this makes a list of what was approved by the board, when it was approved, and what was approved. As Larry said, the primary changes are asset allocation and rebalancing ranges. Those are the most substantive. Some tweaks, a couple of law changes. For example, the basket clause allowed for 10% real estate up from 5% to be an eligible investment and not included in the basket clause. The actuarial assumption rate went from 8 gross to 7 net. And then we approved a lot of individual IPSs, the hedge fund IPS, the OFI IPS, the real asset IPS, and the PE asset IPS. Those are the substantive ones. And if you have any questions.
Seeing none, I think what we'd like to do is have the board adopt a conforming IPS, and I think we've had a request just to circulate the adopted copy to the board members.
This would be the time that everybody has a nice clean copy of the investment policy, given the fact that we've already voted on these issues. I'm sorry, this would be the time to everybody to have an actual copy, a clean copy, conforming with all the decisions we've already made and the changes we've agreed upon. So I think this is the time to have it.
May I ask, has the law department reviewed this document?
To the best of my knowledge, it has, because they were the ones who thought that we left out the securities litigation.
And so have they provided an opinion to this board that this is something that we can approve at this time?
We've not sought an opinion from them.
I don't recall in the past that we had a sort of opinion as to that.
And Barry, have you and have SIS taken a look at this document and have had a chance to thoroughly review it? Because I know it has just come out recently.
Depends on thoroughly, but I've read through it and I like it. Too long for my taste, but otherwise it's very thorough.
It's fitting for New York City.
I guess thorough, yes. Accurate, is it accurate
Yes.
based on the decisions that the board has made? I did notice that a number of the appendixes were missing from the version that we received. And there were some changes I know that we had to those. So is that something you can provide to us?
Sure.
With the full document so that we can review it?
I'm sorry, I can't hear you, Janice.
As a full document,
Sure.
so that we can review it as a whole. And I would feel more comfortable reviewing the document once the law department has provided the board with its certification or whatever, just some sort of indication that it has reviewed the document and is fine with it.
I'm not necessarily in agreement with that. Law Department doesn't necessarily dictate the investment policy to this board. It's the board that comes up with the investment policy. And that's consistent pretty much with decisions, albeit not in the investment arena, but in other decisions. The board determines the necessities and investments and other matters that come before the board. So I'm not comfortable with the law department, but why don't we ask the law department, oh, that's right, they're not here. They choose not to come to this meeting, they choose not to be involved, and that's consistent with what I just said. This is up to the board to decide the investment policy statement, what goes into the investment policy statement, not the law department. So I think that we just need to, we've already voted on these matters. This policy statement reflects the decisions of the board in the past, and I don't see why the law department needs to opine whether we were right or wrong on this investment policy statement, or whether they need to approve it. So I'm in disagreement with that, and I propose we go forward on this.
Well, I don't think we need the law department to approve it, but I don't see any reason why we shouldn't get the benefit of their advice on any fiduciary matters involved. They don't make the investment decisions. They could give us legal advice about some of the policies that are in there.
I think they come, and when the board asks for it, I don't see a need for it.
So Joe, could I interpret that as a second of my motion to adopt the conforming IPS?
I second that.
Well, I think I'd like to take a few minutes to have a caucus, please, before we vote.
By the way, I just want to remind that everybody was here when we've already approved these matters before the board, and they've had plenty of time to ask the law department to opine on this. They're grabbing their jackets.
We're still in the air.
Are we? I think we're off. There's a caucus going on, so that we're off. We're back on the record? Okay. So I believe there's a motion on the table.
We're back from our caucus, and we'd like to do a roll call vote on this.
Roll call vote on the issue. Controller,
4.
Finance,
Nay.
Mayor,
Against.
Police Commissioner,
Against?
EBA,
For it.
SBA,
4.
LBA,
4.
CEA,
For it?
DEA.
For
All right, motion carried, 7.5, 4.5.
Thanks very much. We'll get it out with the appropriate appendices.
Appendices. Before we move off of this issue, I would just like to thank you for all of the work that you've done in updating this document. I also would like to discuss an update of, not just an update, but a review, a comprehensive review of the document. I too agree with Barry that perhaps the document is a bit long and wordy, and it appears that it has not been perhaps reviewed since before the financial crisis. And I was looking through the changes, and on page 25, there is a line that says that a review of this investment policy statement shall be undertaken no less frequently than every 3 years. And it seems that we're a bit overdue for that. So I would like to ask BAM and SIS if they could start on a project to undertake a review of the document.
That's what the board would like us to do. How about we first get out the conforming copy first?
Yeah, why don't we table that matter? I think that till we get all the updated copy and everybody can review it. But I just want to take exception with one point. While that may well be, I understand finances and the mayor's motion to maybe review the matter, but it's a document that's should be reviewed by the Board of Trustees. And in fact, it's come up for a vote, according to this, on page 26, since January 2008. So if anybody's had any major issues with the IPS, they're always welcome, as is the authority of any trustee at this table, to bring up the matter before the board and request some sort of modification or changes. So I think this has always been reviewed, I believe, since at least 2008 and before that. So I think I agree with Larry, though. We should have it. Everybody should have a copy and review it, and then we can make the motion next month.
Well, I'm comfortable making the motion at this meeting. I think that we will get the amended policy at the next meeting, and that should be an opportune time to undertake a thorough and complete review of the document.
Janice, can I ask you, shouldn't it, without getting too far ahead of myself personally, I presume come the new year I won't be a member of this board anymore. I presume that the new controller I assume there'll be an election. I can tell you that the current controller is not running for re-election, therefore I presume there'll be a new controller, therefore I presume the new controller will bring a new CIO. I gather that the mayor's not running for re-election, therefore there'll be a new mayor, therefore the entire city side will be newly staffed. Wouldn't it make sense for the new board, as reconstituted next year, to pick up this conformed IPS and do what it wants with it?
Absolutely, but I don't know why that can't be one of the first items that the new board takes up come January, so that if the work is done during the fourth quarter of this year, then the new board coming in can have a fresh copy, a new copy, a streamlined copy perhaps, from which it can begin its new session.
I think it's presumptuous for us to do the work of the new board.
I think the majority of the board members will still be here.
Larry Wilson will be here.
I was going to say, it's not a majority of the board that will still be here. I think the union members will be here, but no one from the city side will be here.
They're not the ones that made the motion, by the way, but
The unions.
yeah, the unions didn't make the motion to bring this up to discuss.
But the unions will table the motion.
Right.
So I prefer to wait till next month to review the matter after I have a final copy of the investment policy statement. And then I think that's the best time to bring the motion up, and let's talk about it then. So I'd like to table that motion.
I'm happy to
So
table it until next month.
There you go. Let's move on.
Okay, so that ends the agenda, the public session of the
So I make a
pension
motion
fund.
that we leave the public session and go into executive session.
No, we have to do the public session of the variable.
Oh, I'm sorry. So leave the public session of police pension fund and make a motion to go into public session of the variable, of the police officers' variable supplement fund
POVSF.
first. The POVSF.
Any other second on that?
Second.
Thank you.
Yeah, I think you need a copy of the POVSF.
Yes, please.
Yeah. And, yeah.
Want to give another one of those? All right, that's all right. I'll share with Thaddy. Thaddy, okay. Go ahead, Mark.
Shall we have a, we're ready to go, Mark.
Okay, so everyone should have a copy of the quarterly report. Turn to page 3.
Are we still on? Yeah, I want to make sure that it's a public session.
Turn to page 3, you'll see that the fund has $465 million as of June 30th. On the left, the returns were positive, 117 ahead of the benchmark, and the returns were very strong for the fiscal year 12-month period ending June, almost 14 and a half, 24 basis points behind, and for 3 years, 12.99, 8 basis points behind. The asset allocation is fairly simple. It's 70% in U.S. equity, passively managed, and 25% in the Core Plus 5 program. You'll see we were slightly overweight the U.S. equities and slightly underweight Core Plus 5. Because of that, the attribution on page 5 of the quarter shows positive numbers. The underweight in fixed income and Core Plus 5 helped. Management effect was roughly neutral because of the passive nature of 70% of the portfolio. And the 1-year period shows negative allocation effect. That's mostly due to any cash that was held in a very strong market. And again, the management effect, while positive, was very, very modest. And for the 3-year numbers, allocation effects were negative, again, slightly because of the cash. But managers in EFA and Core Plus 5 did well over 3 years. EFA does not exist presently here, but at that time they did well. If you turn to page 12 and 13 are effectively the same pages. There's one equity program. The equity program is the passive Russell 3000 portfolio. That's 72% of the fund. For the quarter, it was a strong quarter, and as you expect in the passive mandate, the returns and volatility were right on top of the benchmark, returning 269. For the fiscal year, very strong numbers of 2145, and 3 years, 1861. Fixed income is shown on page 16, the Core Plus 5, broken down. And you'll see very similar numbers that we showed on the pension fund side. In this case, 25% of the fund is invested here, or over $100 million. The returns were also negative, but slightly ahead of the benchmark on page 17 on the left, 2 basis points ahead. Fiscal year to date, again, slightly negative, minus 0.5%, but over 40 basis points ahead. And for 3 years and on, the returns were positive in the 4 to 6% range. That's all I have for you for this quarterly report and the fiscal year numbers.
Just a point of question. We have, I believe, enough in the fund for at least, 2-3 years? 2 years?
You certainly have enough for this year, and I think you'll be fine for the following year. But then you could be in the same position as the police superior officers' variable supplement fund, unless there is a skim.
But with the passage of the law based on your recommendations from last year, the mechanism will be in place, I believe, right?
Yes, Chapter 3 of the laws of 2013 provides that in the event the assets are insufficient within the variable supplements fund to pay the benefits as of each December, the money will be transferred from the police pension fund to make sure that the payments are made timely. That mechanism was used for the police superior officers
variable supplement fund this year for a part of their payments.
So, make a motion to adjourn the public session of police officers variable supplement fund. We need to go into public for the superiors? No? Okay, so I make a motion then that we go into, I'm sorry, I think we need a motion to go out of that.
exit. Second, Benny. SBA, thank you.
Make a motion to go into executive session of the police pension fund.
Second, thank you. All right, we'll take a 5-minute break, thank you.